Welcome there, Investorholics, to today's Spotlight Review. In this presentation today, we'll be looking at PAI, which is the Platinum Asia Investments Limited. And that one's brought to you guys by our friends at Platinum Asset Management. So PAI is an ASX listed investment company. PAI offers investors with easy and convenient means of accessing an actively managed, diversified portfolio of Asian companies across industry sectors, providing exposure to undervalued businesses that are benefiting from Asia's dynamic growth and transformation. So this one's a bit different to what I normally do, so hang around. I thought it'd be just interesting to give a comparison on the Asia series I've been doing, so just a little bit different, same flavor but just a little bit different spices, if that makes any sense. Hang around, guys. Hey there, Investorholics, this is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at Crack the Sky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, so let's do a quick bit of background because this is something a bit different. So what is a listed investment company? A LIC is an investment listed on the exchange, such as the Australian Stock Exchange, is incorporated as a company. Many LICs operate like a managed fund. They have an external internal manager who selects and manages the company's investments. LICs are closed-ended, so this means that they don't issue new shares or cancel existing shares as investors join or leave. So instead they issue a fixed number of shares at the initial public offering, so the IPO. Investors then buy and sell those shares on the exchange. This allows a fund manager to focus on investing without having to worry about cash flow. So if an open-ended fund, units are bought and sold, so you've got to be constantly selling shares and stuff to redeem funds for investors. So as LICs are companies, they pay franked dividends, so that's one of the differences with ETFs and that type of stuff. So some of those ETFs don't actually pay all their dividends out. So anyway, let's move on. So investment objective, provide capital growth over long term through investing primarily in undervalued listed securities of companies in the Asian region. So it aims to achieve net return over 5 years plus investment horizon that are in excess of the benchmark. So obviously we always have a look at the Y factor, and that's the reason we're here. So access to a manager with a proven investment philosophy and method of selecting undervalued stocks, and a team of experienced investment professionals. Also gives you exposure to an actively managed diversified equity portfolio that seeks to minimize losses during market downturns using risk management techniques. So actively managed currency exposure, providing substantial diversification from the Australian dollar. Easy to trade on the ASX, so pretty much, you're only limited purchase-wise by the minimum for your platform. Typically, most platforms are $500, but there's some platforms that let you trade a little bit less than that. So yeah, easy to buy and sell if you're interested. Okay, so net asset value, when I did the research, we were looking at $1.3239, trading below that at $1.22. Market cap roughly $445 million. Management cost, as with all these LICs and these type of things, the management cost is always high because obviously it's actively managed. So 1.1%, and as with this kind of typical of these things, you've got a performance fee above that, so 15% above the outperformance over the benchmark. If you want to know more about the benchmark, hop onto the Platinum Asia Investment Limited website and you can find all that stuff out. Semi-annually, you get your dividend, and that is March and September. Dividend yield of 4%. So PAI typically invests in 50 to 100 securities in companies based in China, Hong Kong, Taiwan, South Korea. They're the major ones, but then got a smattering of investments throughout the other countries listed there, I should say. PAI might be suitable for an investor searching for an actively managed exposure to emerging markets, Asia, and a reliable frank dividend. As always, we should be doing our research, so also have a look at VAE and IAA, just sort of see how they compare. As a rule, I'm not a massive fan of actively managed investments, investment companies, I should say, get my tongue around that one, mainly due to the high management and performance fees, as we've kind of touched on just before. Typically the fund managers they try to justify their existence, so at times they what I consider unreasonably, they're creating an unreasonable amount of churn, so a lot of buying and selling just for the sheer fact that they've got to do something, not because it necessarily is good for the shareholder. As we will see on the next slide, if the churn was lower, I think the actual outcome for the investors or the shareholders would actually be better, and actually you'll see better performance on the stock. But yeah, anyway, let's flick over and have a look at that right now. Okay, you've got your top 10 here on the left. So AIA, Alibaba, LG, Ping An Insurance, Samsung Electronics, SK Hynix Inc., Taiwan Semiconductor, Vietnam International Investments, I'm assuming that is, Weichai Power, and ZTO Express, Cayman. So a lot of Chinese companies there, but those companies are the usual suspects as well in the other major ETFs. So a lot of those you're going to see when you do your research. So China proper makes up 42%, just over 42% of the shares held in this LIC. Hong Kong makes up 7%. Taiwan makes up 5.4%. India makes up 7.3%. South Korea is 10%. So they're the major jurisdictions where most of these LICs or ETFs actually hold their stocks in. So that's sort of a lower exposure to other companies further down the list. So if you're looking for exposure to, say, Vietnam or Malaysia, or wherever, you might need to actually look for a specific ETF or LIC that focuses on those countries. Sort of touching on what I sort of mentioned before, looking at the performance graph on the right hand side, as you can see, the performance runs pretty well in parallel over time. particular times in the market, the index is outperforming platinum, and then you'll see a switch back over where platinum will outperform the index. But as you can see, you know, the only time that they're actually outperforming as active managers is in the last 12 months. So, you know, does that really justify you paying them that active management fee? I'm sure that they're happy to get their outperformance fee now for outperforming the index, but you know, really, you know, is it worth paying that extra 0.5% or whatever it's going to cost you to be an actively managed fund when an ETF actually is going to buy all those, or you know, probably I'd say 5 or 6 of those top 10 holdings are in most of the Asian ETFs anyway. Really, the one point that I kind of didn't touch on, the fact that I'm not a huge fan of LICs anyway, just pretty much for the fee structure. But also another thing to consider with this, if you are looking at buying it now, actually might be a good time to buy it for the sheer fact that it's actually trading at a discount to the net tangible assets. So kind of as we sort of touched on before, I didn't really focus on it, but thought I'd leave it to this slide. But it's something to consider when you're buying ETFs or LICs. If you're buying or paying per share less than what the per share value of the underlying assets are, that's a good deal. And this LIC is actually trading below its net tangible assets. So if you are interested in this LIC, it might actually be a good time to buy now, because there's actually a lot of M&A activity where other bigger managers are buying these undervalued LICs up because they're pretty much trading a discount to their net tangible assets. So might be one to look at if you're willing to stomach the extra fees that the LIC, this particular LIC is charging. So anyway, have a great day, guys. Hopefully this was informative. Yeah, have a great day and look after yourself. Ciao. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks, guys. See you later.